Hello folks, Steve Lance here with Discover Options, and welcome to this edition of several market reports for Friday, June 9th, getting ready for the open on Monday, June 12th. Presented material is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Folks, we're going to cover three reports for advanced options traders today. Our Condor Butterfly Timing Report for the S&P 500, also our Bull Put Spread Timing Report, and our Directional Likelihood Report. Please subscribe to get alerted to more recordings that we post. Also, if you want a free ebook, just click on the link, give us your information, and we'll get you this free ebook, Simple Steps to Options Trading Success, co-authored by myself and Jim Graham. The current market condition is like this. Thursday was an upswing day, and then Friday was an outside bar day. All right, quite dramatic. That occurred when we were above the 50-day simple moving average. We're trending upward here. But the stochastic, the 15-3 stochastic, is trending downward. It's about 88 or so, which is between 60 and 100. That's a nice little region to define this market condition. Combined, all this is a condition that has occurred only about 34 times since Jan of 2000. Not too often. Okay, so keep that in mind as we move forward. Let's go to the Condor Butterfly Timing Report for you advanced options traders wanting to extract a little bit more of an edge in the timing of your when you begin your campaign in these advanced strategies. Here we go. Since Jan of 2000, there's been over 4,300 daily closes of the SPX. Now, of those, 65.2% have been favorable bars for selling premium, where the actual 21 bar movement was less than the SIBO skew adjusted implied movement. All right, 65.2% of the time it turned out to have been favorable. You could have flipped a coin. 65.2% of the time you would have chosen a bar that turned out to have been favorable for doing condors or butterflies, where the market didn't move as much as what the option prices were saying. All right, so also during that time, our current condition has occurred, like I said, 34 times. Now, of those 34 times, 76.4% of those bars were similarly favorable for selling premium neutrally. Now, this implies then an edge of 11.2%. Pretty darn good. So statistically, it's more likely than usual that Friday's bar will end up having been favorable for market neutral option premium selling. Not too bad. That's the Condor Butterfly Timing Report. Now, for those of you selling credit spreads in the puts in the S&P 500, or leaning condors a little bit long, maybe you're doing out-of-the-money put butterflies and leaning those long. Lots of strategies out there teaching that approach. Here we go. So, since Jan of 2000, over 4,300 daily closes. Now, out of those 4,300 and 47 actually to be exact, 82.8% of those turned out to have been favorable for selling put premium 30 days out, a standard deviation out of the money. Okay, you could have flipped a coin, and 82% of the time, index would not have gone down that far and struck your short put strike. Not too bad. Now, and that's just the nature of the SPX. Now, but during that same time, we have our 34 occurrences of our current condition here. Of those 34 occurrences, 94% of the time, the market did not go down that far. They turned out to have been similarly favorable for selling out of the money put premium like that, standard deviation away 30 days out. So this implies a put premium selling edge of 11.2%. Statistically, it's more likely than usual that Friday will end up being a favorable environment for selling out of the money put premium. Not too bad, okay? So there's the Bull Put Spread Timing Report. Let's go to the Market Likelihood Report now. What are we looking at here is simply a picture of price distribution, upper 5, 10, and 15 days, lower 5, 10, and 15-day distribution bands getting struck. What do we mean by this? Here we have 5-day distribution bands, set one standard deviation away 5 days out. And the question is will price go up and hit the upper band, the lower band, or wobble around and stay in the middle? We set these 5 days out, 10 days out, and 15 days out like you see here. And when we look at the distribution, we can see that over 4,347 occurrences since Jan of 2000, price struck the upper 5-day band almost 30% of the time. The 10-day band on the upside, 23%. 23%. On the downside, the lower 5, 10, and 15 days, 29, 29, and about 32. Now this is using a 20-day statistical volatility number. I also like to mix this up, and I'll show you in a bit, using a VIX calculation. Using the VIX, and I skew it so that the upside is reflecting a lower volatility than the downside, because the out-of-the-money calls have lower implied volatilities than the out-of-the-money put options, so we skew adjust those. But so this is the distribution over 4,300 times. Now, when we go to our market occurrence, our current occurrence of those, in this case 35, okay, price of those 35 occurrences, price struck the upper band 20% of the time, which is less than the benchmark by 9.5. But you can see it struck the upper 10-day band more often, the upper 15-day band more often. It struck the lower bands less often across the board here. So this is a picture leaning slightly